Investing in real estate has always been one of the most reliable ways Canadians build wealth. For decades, it's been a go-to move for families looking to build equity and secure their future, especially here in Ontario. You buy a condo, you rent it out, and you hold it. That was the formula. It wasn't just common, it was proven. People were making six-figure profits without ever needing to flip or renovate. I've seen the good, the bad, and the ugly. But what I'm seeing right now in Ontario's market, particularly in Toronto and the GTA, is nothing I've ever experienced before. Prices are softening, rents are cooling, inventory is piling up. Interest rates are still high, and the government regulations, they're making the returns on these investments shrink fast. Investor sentiment is shifting, confidence is fading, and to be completely honest, I've already listed one of my condos for sale, and I'm seriously thinking about selling the rest. If you're an Ontario condo investor or you're thinking about becoming one, this isn't a video to scare you, it's one to prepare you. I'm going to walk through the real world math of buying and holding a condo in today's market, the hidden risks that don't show up on your agent's spreadsheet, and the long-term outlook that could flip the market again in 2028 or 2029. Because yeah, real estate moves in cycles, but you don't want to be the last one holding the bag. Let's go back to the early 2000s. In 2005 and 2015, Toronto condo prices rose by nearly 185%. And that sounds like a lot, but just wait. From 2015 to 2018, prices spiked again, up another 75%. All in all, we saw a 324% increase in the condo values in just over 13 years. That's why investors piled in. Who wouldn't? You had double-digit growth every year. People were pulling equity, buying second and third properties, and retiring early. I know investors who bought a $250,000 unit in Liberty Village in 2006 and sold it for over $700,000 a decade later. It was the definition of passive wealth creation. But then 2018 hit. All things started to stall. Since then, condo prices in many parts of the GTA have gone flat, or worse, they've dipped. In some pockets of downtown Toronto, values today are 9% lower than they were in 2018. And when you factor in inflation, that loss is even bigger in real terms. If you bought in 2018 with the expectation of appreciation, you're probably disappointed, and you've been carrying negative cash flow on top of that. You might be reconsidering this whole strategy altogether. Let me walk you through the pro forma. This is a simple version, but it's based on real numbers that I see every single day. Let's say you're buying a one-bedroom condo in downtown core for $620,000. You put 20% down, that's $124,000. Your mortgage is based on a 30-year amortization at 4.2%. So roughly $2,400 a month. You rent it for $2,700 a month. Now that sounds all right so far, but let's plug in the rest. Condo fees, $350 a month. Property taxes, $170 a month. Insurance, $60 a month. Maintenance, 2% of the annual rent, which equals $650 a year. Property management, even if it's you, 8% of the monthly rent equals $216 every single month. All in, your operating comes to about $1,775 monthly. Subtract that $2,400 a month mortgage payment and you're negative $625 a month. That's $7,500 out of your pocket every single year, and that doesn't include vacancies or surprise repairs. This isn't just a one-year hit. You carry that negative cash flow for over a decade. Based on projections, you wouldn't break even on a monthly basis until year 12, and you wouldn't fully recoup all of those early losses until year 21. This is what we call feeding the property. You've been paying to keep it afloat month after month, year after year, unless you got appreciation. So what if the market rebounds? Let's say we model 3% annual appreciation. After 10 years, you could see a total gain of around $220,000. On paper, that sounds great. But remember, you were negative for 12 years just to get there. And what if there's no appreciation? What if we stay flat like we've done since 2018? That 10% profit drops to $16,000. That's barely 1% annual return on your $124,000 down payment. And that's just clearly not an investment. That's a part-time job where you lose money. And this doesn't include the psychological toll. Tenants, maintenance, building issues, special assessments. Anyone who owns a condo knows there's always something. So let's talk about the elephant in the room, tenants. In Ontario, the landlord and tenant board is so overwhelmed that getting an eviction process can take 8 to 12 months. That's a full year of covering expenses without income. And unfortunately, the rise of the professional tenant is real. These are people who know how to game the system. Fake paperwork, delay payments, legal loopholes. By the time that you get them out, you're tens of thousands of dollars in the hole. And even good tenants are risky in a volatile market. One job loss, one expected life event, and becomes a liability. Ontario also has rent control. That means that you can only raise rents by the government's set amount each year. In 2021, it was 1.2%, and in 2022, it was 1.5%. Meanwhile, insurance, taxes, maintenance, up 6 to 8, even 12% depending on your building. You're capped on income while your costs continue rising. It's like trying to fill a leaky bucket with a teaspoon. And if you get stuck with below market tenants for multiple years, you can't adjust. You just absorb those losses. Now let's talk about Airbnbs. A lot of investors tried to sidestep rent control with short-term rentals, but most major Ontario cities have cracked down. In Toronto, unless it's your principal residence, you can't legally operate an Airbnb. The city is enforcing it too. Fines, inspections, you name it. For many, this regulation killed the big chunk of expected revenue. Now let's not forget about supply. There are over 160 purpose-built rental units under construction across Canada. A large share of that is here in Ontario. These aren't convo conversions. They're dedicated rental buildings with amenities, incentives, and professional management. As these buildings come online, vacancy rates will rise. Landlords will need to offer months of free rent, flexible lease terms, or upgrade just to attract tenants. And that puts further pressure on smaller condo investors who can't compete at that scale. So what's the play here? I believe that real estate works when it's part of a bigger strategy, not just a blind buy and hold. Right now, I'm relocating. I'm looking at fixed income products, joint venture opportunities, even land banking. That doesn't mean I'm giving up on condos forever, but I'm not fighting the market either. Eventually, this investor pullback will create a supply punch. Pre-construction sales are already down 90% in parts of the GTA. Developers are canceling or delaying projects altogether. Permits are slowing down at City Hall. And once that inventory dries up and demand returns, prices will climb again. I think that rebound starts around 2028 or 2029. That's when I'll be ready to re-enter. But today I'm out, the math doesn't work, the risk is too high, and there's better places for my capital. If you're holding a condo and wondering what to do, sell, refinance, restructure, I can help run those numbers. I'll show you exactly what your ROI looks like and what your options are, and whether holding it makes sense. No pressure, no sales pitch, just facts, strategy, and solutions. Book a call using the link below or visit chaussemortgages.ca, and I'll give you clarity. Hit the like button, subscribe for more real, no BS real estate talk, and share this with someone who might need to hear it. The market is changing, and the winners will be the ones who change with it. I'm Justin Chausse. Thanks for watching, and I'll see you in the next video.